Hi there, everyone. Welcome to Chart This with Dave Keller. I wasn't ready for that countdown to be over. I somehow mentally went back to the 60-second countdown. I'm like, I got plenty of time to bring up the dollar chart, think about some other things, but it's go time. Welcome to the show. I'm your host, Dave Keller, here from Market Misbehavior. Thanks for joining me on my daily market recap show. We're coming to you from a kind of nice and comfortable mid 50s kind of day. Not too hot, not too cold, not rainy in Redmond, Washington. I hope things are well wherever you're tuning in from. Those of you tuning in live on Facebook, LinkedIn, YouTube, and X, I appreciate you so much doing so. Thanks for asking questions all along the way. Thanks for chatting with each other. Makes it interactive, makes it interesting, and usually gives me a couple questions that are fun to take at the end of the episode. Any of the questions we don't get to, we will put into the mailbag, and we're planning an all mailbag episode again this coming Friday. The last couple of Fridays have been some really fun episodes, really wide-ranging questions about technical analysis, about market dynamics, about breadth and sentiment indicators, about particular charts and tickers. Anything is fair game, and I'd encourage you to ask questions as we go. If you're watching the replay on our YouTube channel, just put a comment below the video with your question, and we would love to take it. Have received some feedback on the facial hair. There's a cyclical nature to things like the VIX and the markets. Also to Dave's beard approach. It really just hits me, and I decide not to, whether or not to start trimming a beard or continue to shave it. I'm on a beard phase. I actually think I switched right at the peak in February. So at the proprietary Dave Keller Platinum service, I'll tell you when I'm thinking about shaving it off. Maybe we can get ahead of that a little bit. I say that with a great dose of sarcasm, but I'm digging the beard again for at least a little bit of time. We'll see how long that lasts. Fed Day today. So happy Fed Day. I mean, in a lot of ways, not a huge event, although the market obviously rallied pretty aggressively after the announcement, which is really kind of a non-issue. I mean, the market was not pricing in anything but what they said at 2 p.m. Eastern, but at 2:30 Eastern, you can see the rally continued up until around 3:15 Eastern. And then for the rest of the afternoon, we kind of sold off. So great news that the market rallied. Certainly Powell opening the door to additional rate cuts kind of reaffirmed that is something that they are generally planning to do. But by the end of the day, investors selling into that strength kind of immediately post-Fed. So it wasn't all a feel good. It wasn't this is going to make things better no matter what. It was more of a yet another question mark, I feel like. All right, let's go to the market recap and see how things generally played out here. And again, this Fed meeting was not anticipated to be a big directional move kind of day, at least in my assumption. The market's often rallied around Fed meetings. And again, I think when you give the microphone to someone whose goal it is to reinforce that the Fed's got it all covered, I would expect the market to rally a little bit, even if conditions are not that good. The question, I think, really is what happens tomorrow and Friday once we sleep on what all we learned here and learn if that really changed the picture too much. This short-term rally in the S&P continues, really started last Friday. And today you can see the S&P closed another 1.1% higher. That's above Tuesday's close. We finished today around 56.75. The NASDAQ composite up 1.4% and the Dow up just slightly less than 1%. Mid caps, small caps, all up as well. The NASDAQ, the best performer out of that group of indexes that I just mentioned. The VIX moving lower, slightly below that 20 handle, which is an important one for us, right? Above 20. And again, this is a back of the envelope calculation, but above 20, high volatility, higher uncertainty, higher potential for a decline. VIX sitting below 20, lower volatility, low uncertainty or lower uncertainty, certainly, and low probability of an aggressive decline. So this short-term rally in stocks finally pushing the VIX back below 20. And that might be an important data point to monitor through the remainder of this week. If VIX can remain below 20, that just is sort of a check in the bullish column, I would argue, right? Generally, because given how volatility has been elevated, VIX sitting below 20 is actually very low volatility for 2025, very high volatility for 2024, but guess it just depends on your frame of reference. So decent update continuing this, what I'm still describing as a counter trend bounce in the S&P 500 and the NASDAQ 100. Interest rates is where you saw quite a bit of movement. You can see the 10-year Treasury yield, which we'll bring up here, got up to about 4.3% going on into around 2 p.m. Eastern, which is when the Fed, decision is announced. 2:30 is when the press conference starts. 3 p.m. the bond markets close. So 10-year yield went from around 4.32 to finish right around 4.25 going into the end of the trading day. So bonds rallied going into the close as stocks generally did as well from 2 p.m. on. So the TLT, which is a Treasury bond ETF, up about 0.5%. The dollar index, really not much of a change, using the UUP, up 7 cents from yesterday. That's essentially slightly higher, but not by much. And rates generally moving down as the Fed talks about having an appetite for rate cuts. For now, market taking that as a pretty encouraging sign. Commodities overall a little bit mixed, but generally higher. You can see the DBC, which is a broad commodity ETF, finished up about 0.6%. Gold up 0.4%. Silver actually down. Gold and silver usually move pretty much together, so this is a little different. Of gold higher, silver lower. Chart of the price of gold reminds me, my latest episode of the Market Misbehavior podcast released interview with Jim Puplava. Jim is the founder of Financial Sense Wealth Management based in San Diego. Jim is a longtime podcaster, and before that, radio host. He hosted the Financial Sense radio show going back to the 1980s. When you hear him talk, his voice may sound familiar. He's got a fantastic, just classic radio host voice. It's awesome, but I mean, really knowledgeable. And I've been on his show a number of times, answering questions and being interviewed, and it was really fun. I was so glad he accepted my invitation to return the favor, come on my show, and I got to ask him a bunch of questions about Trump policy decisions, about fundamental, technical, and political pillars, which are his 3 pillars for investing. So you can check out that podcast on our YouTube channel, again, with Jim Puplava. That just went out a couple hours ago, so still pretty freshly posted. Looking elsewhere in the commodity space, copper prices continue to move higher. I mean, China remains one of the better charts you'll see. Chart of the FXI looks a lot better than the chart of most U.S. markets right about now. And copper prices going up, given the expected additional demand coming from there, among other places. Crude oil prices slightly higher. Energy stocks doing quite well. Natural gas up. But energy is kind of a head scratcher for me. I feel like crude oil prices aren't justifying the nice rally you're seeing in things like Exxon and Chevron. It's kind of the big integrateds that are popping higher. Some of the others not as much just yet, like a DVN. Still pretty underwater in terms of the historical trend, still arguably in a primary downtrend, but Exxon, Chevron both making new swing highs today. And we'll get to, I grabbed one of those. I think it was Exxon earlier. Looking at the cryptocurrency space, and I tell you what, biggest surprise of my conversation with Jim Puplava, I don't know if we've ever talked about cryptocurrencies before, and I asked him about it, and he was pretty bullish, constructive long-term. And this is someone who, works for a lot of high net worth individuals, managing family money and estate planning. And the fact that he's talking about Bitcoin being a key part of that thought and the long-term thesis in cryptocurrencies was really interesting. I thought that was a really fun discussion point later in that interview if you haven't watched it yet. Today, Bitcoin having a nice uptrend right over the last 24 hours. We've gone from just above 81,000 to currently trading right around 85,500. That's where we're at right now, up over 3%. Ethereum price is up over 5% today, and most of the others in the green, although a couple in the red today. All right, looking at the 11 S&P sectors, we've got consumer discretionary at the top of the list. I say that again, do not adjust your YouTube feed or your live stream feed, wherever you're watching this. Consumer discretionary is number one. It's been a while, folks, since we have seen that, and that's what happens when Tesla has a decent up day, and there's other key names like Amazon. When they go higher, it turns out the XLY can actually be at toward the top of the list. Consumer discretionary has just been not at the top of the list for so long. This is a bit of a different look here. So we got the XLY number one, up almost 2% today. Energy number two, up 1.6%. Biggest weights there are Exxon and Chevron, two of the big integrateds, and then you've got a number of others as well. Looking quite good. I mean, from a technical perspective, really improving to the point that the XLE is starting to demonstrate some real relative strength here. Industrials number three and technology number four, essentially tied at positive 1.3% today. On the downside, consumer staples basically flat for the day, along with healthcare Real estate just slightly higher. So the three worst sectors basically were unchanged from yesterday. No real significant move. But the stuff going higher had a pretty decent update. XLY number one. That's an important shift from what we've observed recently. Looking at the breadth conditions here, I mean, generally positive to be sure. The Nasdaq Composite, 2/3 of the stocks higher, so about a 2-to-1 ratio up to down. S&P 500, we'll call 73% positive, 27% decliners. So certainly stocks going up, far outnumbering stocks going down. Improving breadth. When you think about what would tell me, because I've clearly pivoted mentally from a market that is innocent until proven guilty, which I think 2024 was all about, to 2025. Certainly in the last month, it has felt like the market's rotated to more, guilty until proven innocent, right? You assume that the primary trend is lower, and then you look for signs that you're wrong. And that's how I tend to approach investing. I define the trend, and then I figure out what's going to tell me that I'm no longer correct on that trend assessment. For me, the trend looks lower, and my medium-term market trend model turning negative a couple of weeks ago was a big part of that. So now it's what would tell you things are getting better. So, stocks holding key support levels, which was an issue over the last, couple of weeks. But now you're starting to find some key names like Meta and others maybe holding their 200-day moving average, right? That would be a good sign. If you start to see some stocks not breaking support like they're not there, but actually holding support like you'd expect in more of a bullish environment, that would be one thing. Breadth conditions improving, and not just on one day, but generally, right? Over time, you start to see some improvements there. For me, I think the only way that the S&P and the NASDAQ have meaningful upside moves from here is it's got to include the mega cap growth stocks, right? The Magnificent Seven have to look a little more magnificent again. They look pretty bad generally, right? Generalizing, they're not good. Netflix looks pretty good, and that's about it. The rest of them, not so much. So you'd have to see the charts that look ugly, like Tesla, look okay. You'd have to have the charts that look okay, like an Alphabet, look better than okay. And you have to have the charts that look pretty good, like Netflix, to really accelerate and start making new highs again. And that's the rotation you need to see within the Magnificent Seven. A day like this makes you feel like it's possible, and it is. But I still think more to prove along those lines. I don't think that any of those things that I outlined are necessarily happening yet, but they're, maybe, right? We have to see how things play out. This is how the leadership names in the growth space did today. Tesla, top of the leaderboard, up 4.7%. Netflix, number two, up 3.2%. Alphabet, up 2%. NVIDIA up as well. And that's an interesting one, right? NVIDIA has been sort of a clear downtrend channel, as we talked about, currently about midway of the way up through that downtrend channel. So a nice update, 1.8%. Meta, the worst performer. Meta is actively testing its 200-day moving average this week, currently up about 1/3%. Microsoft and Apple, two of the big weights in the XLK, not doing as well as the Nasdaq Composite, but doing okay, up 1.1 to 1.2%. I think that's it for there. Another thing I wanted to mention to you, by the way, I did a poll on X, and please make sure you follow me on X. I'm at Keller CMT. I'm also on, what's the other one? Blue Fly, is that right? Am I making that up? I should know this. I'm so sorry. Blue, whatever that thing is. I have to actually look it up here. It's so horrible. I apologize, guys. Blue Sky, right? Blue Sky Social. That's it. I'm on there too. And Keller CMT is my same handle on both platforms. So I have no. It's not a political decision on where I'm at. I'm just happy being where other people are talking about the markets and willing to engage. So whichever platform you're on, look me up there and follow me. I kind of post similar content in both places. But this is a poll I actually put on X earlier this morning. The great bounce of March 2025 continues for the S&P this week. Are you considering the market more innocent until proven guilty, or guilty until proven innocent? Now, keep in mind, I would guess most of these responses came before the Fed announcement, would be my guess, but I don't know, because I kept the poll. It's still open on X. But as just before we went live, I took a snapshot to see where it was at. 58% of the respondents in this poll, again, not scientifically significant probably, but anecdotally interesting. 58% saying guilty until proven innocent. 42% saying innocent until proven guilty. I mean, I didn't vote in the poll, but I definitely would have said guilty until proven innocent. But think about what that means, right? And that's why I feel like most investors get this wrong. This game that we're playing by looking at the markets. Remember, it's not innocent with a period or an exclamation point, and that's it. It's innocent until proven guilty, right? I feel the market is going up, but I am open to the fact that I'm going to be wrong, and I'm actively looking for signs that that's true. And then the opposite, I'm bearish, but I'm open to the fact that we might have already bottomed out and I missed it, and now I'm looking for signs that I was wrong. So I think there's a humility. You have to be humble investing in equities, investing in any sort of active vehicle, because you're going to be wrong a lot, probably a lot more than you want to be. And so the question is, what evidence is going to tell you that you're no longer positioned correctly? And I would encourage you, don't take a position and then bloody up your hand, pounding the table about how right you're going to be. Make the position, but then actively look for contrary evidence. Look for signs that you're no longer right. That's how I think you're going to survive and thrive as the markets evolve, because you'll be ready for those changes. You'll be ready to go. All right, we look at the heat map next. This is a high-level overview of the S&P 500 stocks, but also allows us to go a little more granular into some of the individual moves today. As a reminder, we're just looking at one-day movements here. I don't do a lot of trading based on one-day movements. For me, this is incremental new data that tells me what's new related to the longer-term, medium-term trends that I'm observing, things that I tell my market misbehavior premium members about in our report that goes out over the weekend called the Weekly Flight Plan. This is just incrementally adding information, new info, new data based on what we're seeing. And at the end of the week, we sort of take a step back and do another larger review of market conditions and see if we need to change our thinking at all. So what are our initial assessments here? I mean, certainly more of an up day than a down day, but you can tell it's sort of concentrated in certain sectors, right? Technology looking very good. Intel, a notable outlier. Intel's a name we've been highlighting, and I had that chart to review. We're basically testing that resistance that we've talked about, kind of in that 25 to 27 range, and for now failing to get above there. For me, Intel is a wait and see chart until and unless we can power above those previous swing highs. If so, I think that is a very strong technical configuration called the big base breakout. One of my Fidelity predecessors named Bill Doan, who ran the group in the 70s into the early 80s, made a career out of identifying big base breakout stocks that were in a big consolidation phase, and then something was new. And talking to Bill before he passed away years ago, I really appreciated that simple measure of recognizing when investors were doing something different. And so I think Intel is close, but it's not quite there yet. And today, pulling back about 7% off of that resistance level. But the rest of the technology, pretty good today. Same for consumer discretionary, probably the best consumer discretionary day I've seen in quite some time. The bad news is a lot of these names that are up today have been down so much. They're still down a decent amount for the week, right? Like Royal Caribbean up 5.7%, but we're down from $275 to almost $200 a share yesterday. So this is through yesterday. I mean, Caesars and other gambling names, again, nice bounce, but we're coming off a really low level. So this is not a trend change by my definition yet. This is certainly a bounce off of a very beaten down level, which is good. And if you're a swing trader, these are great opportunities to identify. And there's a whole part of the technical toolkit, of course, to help you identify and optimize swing trading. But for me, as you know, these are more a trade than an investment, which means it's a short-term move, but I don't have enough evidence to say this is more of a longer-term rotation. Cruise lines like Carnival, we featured, I think Norwegian yesterday. I think I grabbed Royal Caribbean for today's show, or I might have mixed those. Carnival Cruise Lines bouncing today 4.6%. We're still down quite a ton off of that late January high. Also within industrials, by the way, and again, airlines, right? Airlines having a decent day, but again, the charts are still pretty underwhelming, I would argue. Defense stocks, Raytheon making a new 52-week high today. GE Aerospace not quite getting to a new high, but I am going to grab this chart to highlight what I would say is probably a pretty clear bull flag pattern. Let me show you what I mean. That's not the ticker. That is the ticker. Okay, so we're going to look at a little short-term, little less period of time. So a bull flag pattern is when you have a run higher like this, and then you have a downtrend of lower highs and lower lows. I'm crudely drawing this and not paying much attention, but you get the idea of a nice rally, lower highs, lower lows. This is a confirmed bull flag pattern only at this moment when you actually break out of that pattern to the upside. And depending on the angle you draw, it may have broken today, it may have broken a couple days ago. I think that really depends on how you draw the channel lines. But overall, what we're seeing this week certainly appears to be a rally, a bull flag pattern, which is a short-term counter trend move, and breaking out of that pattern to the upside is a really bullish sign. If you're a little conservative and this doesn't feel like enough yet, what some people would do, which I think makes sense, is you take a partial position on a breakout like that. You complete the position when we confirm a move to a new high, right? So a bull flag comes after a pretty significant high usually. So take a partial position when you can confirm it's a bull flag, complete the position when we break to a new high, and you've sort of validated that the bull flag was probably a good way to think about it. Maybe something to consider there. I think that's it for the heat map. What else would I say looking here? Healthcare I wanted to mention. So, healthcare, obviously one of the worst sectors today, it looks like, certainly, and some names getting dropped pretty good. Gilead down about 2.5%, back below $110 a share. And this is, after an incredible run into early March. A lot of things, including the S&P and the NASDAQ, peaked in mid-February and have been trending lower over the last month. And now we're getting that counter trend bounce higher. Gilead was actually unusual, and then it just continued to trade higher into the second week in March. And now we're starting to rotate lower just over the last couple trading sessions. So something to watch there, because that's been a pretty impressive name that is just starting to give back some of those gains. Quest Diagnostics, DGX, maybe making a topping pattern, is starting to roll over a little bit. So some of the healthcare names are looking a little bit vulnerable after some really nice moves to the upside here in recent months. All right, we will finish off and look at the chart review. Take a couple. All right, we're back. I might have lost sound, and if we did, I'm so sorry about that. I hope you can hear me again. So if so, give me the thumbs up if you can hear me now. 1, 2, 3, 4, 5. Anybody? Do we have sound or no? Uh-oh. Technical difficulties. Bear with me. Can you guys hear me? There we go. Sorry about that. Apparently, when I did that screen thing, it completely killed the audio. Well, hopefully you got the idea that that's a webcast I'm doing. You can sign up for it if you go to marketmisbehavior.com/relative, and I hope you will do it. And sorry for the audio. I'll fix that for tomorrow. This is what I get when I try to do my own mixing. All right, let's get to the charts here to finish things off. All right, the S&P 500 chart, kind of following the playbook we described. Our general sense of how things were going was the market had topped out. We saw December as a significant peak at 6,100. We saw these additional moves to new highs on weaker momentum as a problem and as a sign of a stalled out or exhausted market. We had a downside line in the sand of 58.50, which was broken at the end of February, and now continuing to go lower. We've broken through the 200-day moving average and now arrived at our downside objective of 5,500. We came up with that objective two different ways. Number one, the height of this basing pattern, if you take a similar move after the breakdown, gets you right to around 5,500. That also represents a 61.8% retracement of the way all the way down to the early August lows. And so that makes a ton of sense. So a move higher off of that level makes a ton of sense from a technical perspective. What we're observing over the last couple sessions, I think, makes sense. Even if you think we're going to end up seeing further lows before this is all said and done, which personally I do, a bounce here makes a ton of sense. Now, how do you differentiate between a bounce that is going to continue to go higher versus a bounce that is just a dead cat bounce or a short-term rally before the next leg lower? A couple things we can do, right? We can look at conditions of momentum to just see overall what's the momentum picture. We can see the RSI still consistently below 50. So even though we've had this nice rally, the momentum is still more weaker than stronger generally with the regular look back period of the RSI. We can see if things like the 200-day moving average serve as resistance. A well documented part of the technical toolkit tells you that once a level is an important support level that is broken, that level will also become resistance. That's a technical phenomenon called polarity, where a level of resistance becomes support and vice versa, which means the 200-day moving average, kind of that 57.25-ish, 57.50 range, becomes an important short level of resistance. We can power above that. It's not a bad thing. I think eventually 58.50, which was the line in the sand that we talk about, I think that's an area. So, that you would expect resistance. So for me, I'm sort of tracking a counter trend bounce up into this range, which is where I would assume if this is the bearish sort of a rotation, a corrective move that is not done yet, that's about the upside limit that I would think makes sense. And if we start pushing above 58.50, I don't think you can call this much very bearish anymore. And you'll hear me start to apply some higher expectations to the market view. But for now, this plays very well with a counter trend bounce off of a key level of support, and a break below 5,500 is what would unlock further downside objectives for me. I think we're down in the 51 to 51.50 range for the S&P 500 in that scenario. By the way, I did post a video on Stock Charts TV Monday, I want to say Monday or yesterday, pretty sure it was Monday, with a kind of choose your own adventure style video, the NASDAQ 100, the QQQ. We looked at 4 different scenarios. You watch the video, you vote on which one you think is most likely and explain your justification. It's a really fun exercise I've done a number of times on my YouTube channel, and excited to share that with the Stock Charts TV audience. So I'll put a link in the description below the YouTube video if you want to check it out, but you can find it over at Stock Charts TV YouTube channel. Make sure you watch that and vote with a comment if you could. So that's kind of the sense that I'm at. Again, this bounce makes sense from a technical perspective. Another thing that would maybe tell you that this is more of a recovery is that the breadth conditions improve much more than they have. We're still below 50% of the S&P 500 members above their 200-day. I would need to see a higher than 50% reading for sure. We're still less than 50% of S&P stocks above their 50-day moving average, which even it's that basic, trend, short-term trend measure. We're still below there. 6 out of every 10 S&P 500 names. So this particular chart, I would need to see these indicators get above 50% before I could be anything but fairly negative about the longer sort of medium-term trend characteristics that I'm observing in the market. I showed a chart with Chaikin money flow earlier this week. I just wanted to add to it today because we've had a couple up and down moves over the last couple sessions. Today, a big update, right? The S&P was up over 1%, which feels like that should be positive momentum. And if you look at the volume bar for the SPY, the day is color coded with in black, which on stock charts means a positive close. So that should be bullish volume. Chaikin money flow really doesn't see it that way. And so even though we've closed higher than yesterday, what Chaikin money flow looks at is where we close versus the range for the day. And if you look, we close slightly higher than the midpoint between the high and the low, but not by much, which means today's volume is actually irrelevant according to the methodology of the Chaikin money flow. It's looking for big up closes where we close at the upper end of the range, or big down days where we close at the lower end of the range, as representing big accumulation or distribution days. So today was more of an even day by the fact that we closed in the middle of the range. That means there was some accumulation and some distribution, but it netted out to kind of nothing, which is why the Chaikin money flow didn't spike higher today. So if you use that indicator, that's how it addresses a day like today. And I think it's helpful when you think about what happened between the open and the close as having value. This indicator does a really good job at looking at trends in volume based on that premise, which is actually the stochastics indicator is built on that same methodology, looking at where we close versus the high and the low for a period of time. So it's sort of applying stochastics to volume, which is one of the things that I really like. So for now, basically set a neutral volume day. I mentioned the choose your own adventure style video on the NASDAQ 100, the QQQ. here's the chart. I mean, I think the recovery, right? If you think the S&P is going to just significantly improve from here, and that this isn't a counter trend bounce, I would argue that has to include the NASDAQ 100 regaining its 200-day moving average and probably much more, because the NASDAQ 100 is, of course, a big play on the mega cap growth stocks. If those do well enough to push the QQQ back into a positive trend, then that tells you that the market overall has potential to go much further. Unless that happens, even if a bunch of value sectors and defensive sectors are doing well, it's just not enough market cap at this point to propel the major averages to the upside much more. So something to look for with the chart of the QQQ for sure. All right, looking at the bond markets, obviously bond markets are pretty important to look at on a Fed day. And again, no real change in terms of the Fed policy, but it was more about expectations about future changes to interest rates and to the Fed policy decisions going forward. Next meeting, I think we're about 6 weeks out from, I want to say. And so we've got some time until what happens next. But for now, I would say the TLT bond prices still kind of in this range, right? From the highs in December and early March, the lows inclining from January and February. We're sort of in this midpoint. We literally close right at the 200-day moving average, which is, look how flat the 200-day has been over the last 6 months. And that tells you, I think, everything about the general trend in the bond markets. It's been choppy kind of sideways. Now, generally, from mid-January to mid-March, I would say this is an uptrend in bond prices. So you've seen stronger bond prices and weaker stock prices generally here in the year to date. I think the question is there enough uptrend? Do we continue to move higher and break out and break above, make a new swing high, break above that trend line? That's what I'd be looking for on the chart of the TLT. The chart of the 10-year Treasury yield, by the way, in a clear downtrend. So while bond prices are going higher, interest rates are generally trending lower. We saw rates chop around quite a bit, and you saw the 10-year yield go down going into the 3 p.m. bond market close. So the 10-year point currently around 4.25. Lower trend in rates, generally tends to mean a couple different things. But one thing that I think tends to be really interesting would be home builders, right? Something like home builders are not a great bet when rates are pretty high, because buying a house is just less accessible. It's less, it's more expensive because of the mortgage rate. And mortgage rate, even though the 10-year yield has come down, mortgage rates have actually stayed a little bit higher than probably you'd expect. But if rates continue to trend lower, if that is one of the outcomes of this week's Fed meeting, that means things like home builders and other things where people would have to borrow money to buy them. It's usually a good sign. Gold continuing to go higher, and again, making new highs this week. Gold above $3,000 an ounce for the first time in history. That general idea came up certainly in my conversation with Jim Puplava. He was super bullish on gold, and he has been for quite some time. That's come up in my interviews with him over time, and I think he's appreciated my technical assessment along the way. That I hope he has, that the trend is positive, right? And gold has been a pretty decent place to be. And again, in an environment where the major averages are so far off of their previous highs, and where it's an open question as to whether they're recovering enough to be considered in an uptrend. How refreshing for a chart like this that is in a clear uptrend pattern above two upward sloping moving averages. There are not a lot of things that fit that particular criteria right about now. Gold continuing to break out to the upside. Intel came off today. We've had this chart on the show the last couple of days just to sort of track day in, day out what we're doing relative to this key resistance level around 26. That was the peak from November. That was the peak with a brief push above there in mid-February, and that's the high so far for this week. Today, we're pulling back and now testing the 200-day moving average. I think, again, the chart of Intel above 26 is a pretty compelling chart. Intel below 26 is an underwhelming chart, right? It's sort of it's a pair of twos, as my friend Carter Worth would often say when he would come through Fidelity. So, not a great chart at a time. I would much rather own charts that are breaking out and in positive uptrends. Royal Caribbean, I highlighted some of the cruise lines having a decent day today. Royal Caribbean actually featuring, what do you call that? A bullish Harami pattern. We have a down day and an up day. and day two's range is narrower than day one's range. It's a bullish harami pattern. It is a short-term bullish candle pattern, but for me, the fact that we're holding the 200-day is pretty impressive. Stocks like this coming down quite a bit from 275 to 200. Holding the 200-day oversold as it tests that level, it has an echo of like the early August low for Royal Caribbean, which again eventually recovered and ended up pushing to new all-time highs. So I would love to see that happen. I think what's great about a chart like this is your risk reward is pretty clearly defined. I don't have a position in Royal Caribbean. If I did take one at the close today, I'm taking that position assuming we're going to regain the 50-day and keep going. Ideally, I'm sort of trading up to that previous high as maybe as an initial upside objective. Maybe that's where I would take some of that bet off. But the downside risk is pretty clear. I'm using the 200-day. I'm using the low of that, swing low in March. That's kind of a limited downside. So very low risk for the potential great reward. So you're out with a limited loss if we're wrong, but you benefit from the upside if we're right. And this is one of those great setups. And this is the benefit of buying something in a pullback phase, right? A long-term uptrend with a short-term pullback can often be a really good place to be. The reason why I'm not saying that same thing about like the S&P and the NASDAQ, because they've broken their 200-day. They did not hold the 200-day like something like Royal Caribbean did. So open question whether that's hold, but that's how you would generally think of that chart and positioning from a technical perspective. Just to finish off, looking at a couple energy names, then I grabbed Visa as well. ExxonMobil back above the 200-day for the first time since early December. And Chevron, I thought I had Chevron as well. Chevron also making arguably a new high, depending on how you create the chart. But these are some of the energy names actually looking quite constructive. ExxonMobil breaking above 112 over the last week has been pretty constructive. Following above the 200-day is pretty encouraging. Exxon and Chevron look fairly good from a technical perspective, but that's about it. I mean, most energy stocks do not look that good outside of like pipelines and kind of weird different energy stocks, kind of like the classic energy names, the core of that sector, not as strong. This is what DVN looks like, for example. And, you think of that relative to like the Intel chart. I think this is a great chart when we get above 39 and kind of push above the 200. That's when I would be interested in this chart personally. For me, it's not kind of there yet. It's sort of like in a sideways mode and stuck between 33 as support and 39 as resistance. I'm happy waiting for it to break above resistance, and that's where I think energy generally looks a little more like DVN than ExxonMobil. Finally, Visa, right? I'm highlighting the chart of Visa, just showing an uptrend channel. The way I drew this was just to highlight the support levels, and then I made a parallel channel which tracked the highs pretty well until kind of late January. We got above the upper boundary, but now we're kind of back right at the midpoint of this range, and we just bounced off essentially the lower trend line. So within that uptrend channel, it feels like we're bouncing off of the lower end of that channel, which means that's what I would think is happening until we break below that trend line, that lower trend line. That would tell me something's different, and that my take on Visa being in an uptrend channel is no longer accurate. But I'm noticing with Visa and MasterCard, a bit of a counter trend bounce that actually fits into a larger, more constructive technical configuration. All right. Do we have any questions? Larry, thanks for watching on YouTube. I appreciate it very much. Do you have a stock charts plugin to be able to overlay the Fibonacci retracements level? So I personally do not have any stock charts plugin, although I have been talking to the folks at Stock Charts about doing something along those lines, but not yet. But maybe you're asking just about in general. So no, I mean, I've actually looked at some ideas about doing a plugin on the Stock Charts platform, doing some sort of premium product. I don't have anything to share with you yet, but something I'm looking at. But in terms of Fibonacci retracements, you can find the Fibonacci retracements to the left of the chart here, and on ACP, there's a section called Fibonacci. Fibonacci levels are used with price retracements, which is what I usually use. I basically say there's the low and there's the high, and that gives you some like potential downside objective support levels between those ranges. You can also apply Fibonacci retracements to time, which is more of a cycle analysis of looking at repetitive patterns, which is something I do very little of, but I'm familiar with them and I've used them before. But that's where you can find all of those cycle Fibonacci kind of framework on price and time sorts of tools. And I'll let you know if I develop some sort of plugin for sure, but not yet. Richard, more of a comment, but I appreciate it. Lots of 200-day moving averages are above the price action. Scary situation, and I love Paul Tudor Jones is quoted or is credited with the quote, "Nothing good happens below the 200-day moving average." And so, for me, particularly when you've had a year 2024, where pretty much everything was above its 200-day moving average for pretty much the whole year. Most things were, right. And so the things that weren't were like the clear outliers. Now the things that are still above an upward sloping 200-day moving average are sort of like, oh, Visa's still in a pretty good technical shape because it's, the 50 days above the 200-day. We're making new highs. That's actually not bad. So it's actually really encouraging to find that there are still charts, which there are. Visa's not the only one that is still above upward sloping moving averages. That's an area that I think is a great potential area to explore, because these are stocks that generally are either not selling off as much as the broader markets, or certainly, still in a much more constructive technical configuration. And those are the things that are going to outperform too, right? Those stocks that are still above moving averages, that are still holding those are the things where the relative strength line is trending higher, getting to the point of our webcast coming up next week. So I hope you'll join me on that. We'll dig into relative strength and a lot more topics in a much greater detail. Folks, thank you so much for joining me here on Chart This with Dave Keller. Apologies for the audio issues, but that's how you know it's live. And then I'm navigating things as we go. But I appreciate you hanging with me and watching our live stream. Thank you, those on Facebook, LinkedIn, YouTube, and X. I appreciate you very much doing so. Hope you find it helps you make sense of these markets, help you navigate things, get a random idea or two about how to use technical indicators, how to use technical analysis, and focusing on where actionable opportunities might be. As a reminder, don't miss my Market Misbehavior podcast. I have another interview coming up tomorrow, but yesterday's with Jim Poplava was a lot of fun, and make sure you listen to that one. The last one with Doug Ramsey was also good too. I'm really thankful being able to talk to some longtime market practitioners and money managers, just sharing words of wisdom about how they're navigating these markets in uncertain times. I think it's a lot of really important, an important message for a lot of investors to hear, to just stay calm, think in the long term, think about hedging, but think about opportunities that could present themselves. For Market Misbehavior, I'm Dave Keller. Have a great night. And remember, it's always a good time to own good charts.